Leveraged index ETFs for long-term investing. Is it worth it? If you had invested $100 a month into the Nasdaq 100 over the last 10 years, you'd be sitting on roughly $43,000 today. That is a fantastic result. But if you had taken that same $100 and put it into a leveraged version of that index, your balance would be closer to $185,000. It looks like a no-brainer, right? 43,000 versus 185,000. Why would anyone choose the first option? Well, the answer is risk. In between those two numbers lies a terrifying 80% crash that would have wiped out most investors emotionally and financially. Today, I'm going to put on my analyst hat to explain exactly what leveraged ETFs are, the mathematical trap hidden inside them that most YouTubers ignore, and the only safe way to trade them using smart investing allocation method. If you are new to this channel, welcome. This is Joe from the Investment Diary. I have been investing for the past more than 5 years and have consistently beat the market in the past 3 years with more than 20% annualized returns. I have traded Forex, commodities, stocks, and options, made painful mistakes and punished by the market, and I would like to share my lessons and journey of investing with you in this channel so we can both supercharge our investments. Support me by tapping on the like and subscribe buttons. First, let's look under the hood. Most people treat QQQ and TQQQ like they are siblings, but they are actually completely different species. Let's start with QQQ, the Invesco QQQ Trust. This is what we call a physically backed ETF. When you buy one share of QQQ, the fund manager takes your money and physically buys shares of the top 100 non-financial companies on the Nasdaq. Think Apple, Microsoft, Nvidia, Amazon. You own a literal sliver of these companies. It is plain vanilla. If the Nasdaq 100 index goes up 1% today, your QQQ shares go up roughly 1%. If it drops 1%, you lose 1%. It's a one-to-one relationship. Now, let's look at TQQQ, the ProShares Ultra Pro QQQ. TQQQ does not just buy stocks, it is a synthetic product. It uses your money as collateral to enter into swap agreements and futures contracts with major investment banks. These contracts are designed to magnify the daily movement of the Nasdaq by 300%. Here is the math in action on a good day. If you are a QQQ investor and the market rises 1%, your $10,000 becomes $10,100. You made a nice $100 profit. But if you are a TQQQ investor, because of that 3x multiplier, your fund rises 3%. Your $10,000 becomes $10,300. You just made triple the money for the exact same market movement. But here is the detail that 90% of beginners miss. TQQQ does not promise to give you 3x the return of the market over a year or even a month. It promises 3x the return for one day. At the end of every single trading day, the fund resets its leverage. This daily reset is the mechanism that creates the massive gains, but also the massive decay. Think of QQQ as driving a sedan at 60 miles per hour. It's reliable. Think of TQQQ as driving a Formula One car at 180 miles per hour. You will get to the destination much faster, but if you hit even a small pothole, the damage isn't just 3x worse, it can total the car. This brings us to the pros and cons argument, which really centers on something called volatility decay. In a smooth bull market, this 3x compounding works magic, but in a choppy sideways market, it destroys you. Imagine the market drops 10% one day. Your TQQQ drops 30%. The next day, the market rises 11% to get back to even. Your TQQQ rises 33%. But because that 33% gain is starting from a much smaller number after the 30% drop, you are actually still down money while the regular market has fully recovered. This is the silent killer of leveraged portfolios. Add in a high expense ratio. TQQQ costs about 1.0% per year versus QQQ's 0.20%, and you have a massive headwind. This is not a free lunch, it is a very expensive dinner. So knowing this danger, How do we protect ourselves? Before you even open your brokerage app to buy TQQQ, we must apply our investing framework. Secure your foundation. Leverage amplifies everything, including your mistakes. You are absolutely forbidden from touching TQQQ if you have high-interest credit card debt or if you do not have a fully funded 6-month emergency fund. Why? Because historically, TQQQ has dropped 80% during recessions, the exact same time you might lose your job. If you are forced to sell your TQQQ shares to pay rent when they're down 80%, you have destroyed your wealth permanently. You must be debt-free first and use leverage second. Next, we look at core versus satellite allocation. A professional investor never bets the farm on a 3x leveraged product. TQQQ belongs strictly in your satellite portfolio. This should be no more than 5 to 10% of your total net worth. Your core 80% should be boring, low-cost index funds like VOO or regular QQQ. Your satellite is where you take risks. If TQQQ goes to zero, which is theoretically possible, you only lose 5% of your wealth. But if it goes to the moon, that 5% can double your total portfolio return. It gives you asymmetric upside with capped downside. Now, how do we actually trade this to capture those gains? We rely on automate habits and ignore noise. In 2022, TQQQ fell nearly every single week. It lost 82% of its value. If you were trading manually, your brain, specifically the amygdala, would scream at you to sell. You would have sold at the bottom to stop the pain. To beat this behavioral bias, you must use DCA, or dollar cost averaging. Set up an automatic transfer of $100 or $500 a month, whatever fits your 5% allocation. When the market is high, your $100 buys very few shares. When the market crashes, your $100 scoops up massive amounts of cheap shares. This automation is the only reason the 10-year backtest I mentioned at the start worked. You need to be buying when it feels like the world is ending. Finally, for those of you who want to take this to the professional level, here is a smart DCA algorithm designed to mathematically exploit that volatility. We follow 3 simple rules. First, establish a baseline. Let's say you invest $100 monthly. Second is the attack rule. If TQQQ is down more than 20% from its all-time high, you double your contribution to $200. You are aggressively lowering your average cost during the crash. Third is the defense rule. If TQQQ recovers and is trading above your average cost or at an all-time high, you halve your contribution to $50. You stop chasing expensive shares and start building cash for the next crash. The smart DCA strategy, or value averaging, is designed to minimize risk by buying less when the market is expensive and buying more when it is cheap. We just finished running the code on a 10-year simulation using real market data from January 2016 to December 2025. The results are fascinating, and they expose a major flaw in how we think about beating the market. Let's look at the numbers. First, we tested the safe asset, QQQ. If you used standard DCA, just putting in $100 every month like a robot, you invested $12,000 total. By the end of 2025, that grew to roughly $34,000. But if you used our smart DCA strategy, doubling down on crashes and pulling back on highs, you only invested $10,150, and you ended up with $27,600. The smart strategy failed on QQQ. Why? Because the Nasdaq is a winning machine. For most of the last decade, the market was at an all-time high. Our defense rule, cutting contributions to $50 at highs, meant you spent years sitting on the sidelines, investing half as much as you should have. You were too cautious for a bull market. Now, let's look at the dangerous asset, TQQQ. Standard DCA invested $12,000 and finished with $83,400. Smart DCA invested $14,100 and finished with $84,300. On paper, it looks like a tie, but if you look deeper, the SMART strategy achieved a massive hidden victory in risk management. Look at the year 2021. This was the peak of the bubble. The standard investor blindly put in $1,200 buying expensive shares that were about to crash. The smart investor, triggered by the high ground rule, only put in about $600. You kept your cash safe. Then look at 2022. The market collapsed. The standard investor put in their usual $1,200. The smart investor, triggered by the attack rule, aggressively deployed over $2,400 into the crash. So while the final dollar amounts are similar, the structure of the portfolio is different. The SMART strategy forced you to own less of the bubble and more of the recovery. The SMART DCA strategy works best for highly volatile assets, TQQQ, where 20% crashes are frequent. For stable assets, QQQ, the defense rule is too conservative and drags down returns. For TQQQ, the strategy did exactly what it was designed to do: protection. Notice that in 2021, the peak, you had only invested $6,500 SMART versus $7,200 standard, meaning you had less money at risk when the cliff edge arrived in 2022. The verdict? The SMART DCA logic works, but the defense rule of cutting contributions to $50 is too aggressive for a long-term bull market. It drags your performance down. The fix? Keep the attack rule. Double your money when the market crashes 20%. That is pure gold. But drop the defense rule. When the market is at an all-time high, don't cut back to $50. Just stick to your standard $100. Don't punish the winner, just exploit the loser. So, is TQQQ worth it? TQQQ is a chainsaw. In the hands of a professional, it can cut down a tree in minutes. In the hands of a novice, it can cut off a leg. If you have your foundation secure and you have the discipline to automate the pain, this can be a powerful tool for a small part of your portfolio. If not, stick to QQQ. The slow road still gets you to the destination. Before we wrap up, I believe in full transparency. As an analyst, I don't just talk about charts, I eat my own cooking. So, do I own these funds? Right now, as of January 2026, I currently do not hold a position in either QQQ or TQQQ. My portfolio is currently allocated elsewhere based on current valuations. However, that is likely to change. I am personally waiting for the next volatility event. When the next market correction hits, and it always does, I plan to initiate a live test of the SMART DCA strategy we discussed today. I will be deploying a very small capital allocation into TQQQ specifically to capture that volatility, using the attack rule we just modeled. I'll document that journey here when it happens, so you can see the mechanics in real time. Finally, a critical reminder. What we discussed today is high-octane finance. Leveraged ETFs like TQQQ are sophisticated, dangerous instruments capable of losing 80 to 90% of their value. This video is for educational purposes only and is not financial advice. I don't know your debt level, your risk tolerance, or your financial goals. You must do your own due diligence before you ever click buy on a leveraged fund. If you enjoy content like this, make sure to like and subscribe, as I will be posting more videos about investing this year. That's it for today's video. See you in my next diary.